Owning a home allows you the opportunity to use your home as collateral for a second mortgage. A second mortgage is a loan you take out using your house as collateral while you still have another loan secured by your house. These mortgages come as open-end or closed-end. An open-end mortgage allows you to continue to take cash out up to the maximum credit amount and can draw again up to the same limit as you pay down the balance. A closed-end mortgage is where you receive the entire loan amount up front and cannot redraw after that. Second mortgages can be used for anything that requires payment, including high-interest debt, home improvement investments, paying for college, and so on. There are two types of second mortgages. One is a home equity loan, and the other is known as a home equity line of credit. Second mortgage uses your existing home equity to fund the loan, and it is secured against your home. Your available home equity is the value of your property minus your mortgage balance. Calculating your equity in your home is fairly simple. Subtract the amount that you've paid toward the principal balance of your home from the total amount you borrowed. For example, if you bought a home for $150,000 and have paid $50,000 on the loan, then you have $50,000 worth of equity in your home. It is important to remember that this is principal only. The interest you pay on your mortgage won't be added to your home equity. A second mortgage usually has a higher interest rate than the first. This is something that you should consider when choosing a loan option to help with your debt. If your current mortgage rate is higher than you would prefer, mortgage refinance may be a better option for you. Common alternatives to second mortgages include home equity loans and home equity lines of credit. The most basic requirement is that you have some equity built up in your home. Other more specific requirements for getting approved for a second mortgage will depend on the lender you work with. Lenders usually require a credit score of at least 620 and a debt-to-income ratio that's lower than 43%. However, this will vary with each individual lender. Second mortgage is different from a mortgage refinance. When you refinance, you pay off the original mortgage with the new loan from the primary lender. With a second mortgage, you must pay your original mortgage as well as another payment to the second lender. With a refinance, you are still only making one payment. If your home goes into foreclosure, then your second lender will only get paid after the first lender receives their money back. This means that if you fall far behind on your original loan payments, the second lender might not get anything at all. This increased risk is why you may have to pay a higher interest rate. There are pros and cons to second mortgages. One pro of a second mortgage is the flexibility in that you can choose how you get your money. With a home equity loan, you will receive one lump sum, and a home equity line of credit, you will have access to a credit line that you can draw from and allow you to defer payments until the draw period is over. Home equity loan lenders usually cover all or majority of the closing costs that comes with receiving your loan. This has the potential to save you thousands of dollars, as closing costs for refinances typically range between 2 to 3% of the total value of the loan. There are also cons to getting a second mortgage. For starters, a second mortgage carries higher interest rates than a mortgage refinance. A second mortgage can place a strain on your current budget. After you take out a second mortgage, you will be paying on 2 mortgages instead of 1. This could prove disastrous for people who are on tight budgets or living paycheck to paycheck. There is also the option of a cash-out refinance. This type of loan, a new loan for more than the amount you currently owe on your home. The difference between that new mortgage amount and the balance on your previous mortgage goes to you at closing in cash. The cash out is the difference between your new loan amount and what's owed on the current mortgage. The cash that you receive from the loan is dependent upon your home equity. So over time, paying on your second mortgage, you could use the extra money from the cash out refinance to pay off the second mortgage and have only one mortgage payment to deal with.